Warren Buffett has seen 60 years of markets. He's lived through crashes, bubbles, panics, and euphoria. And in 2026, sitting on nearly $400 billion in cash, he said something that should worry every retail investor, in India, in America, anywhere money moves at the speed of a phone tap. He said, "We've never had people in a more gambling mood than now. Not during the dot-com bubble. Not during 2008. Not even during the meme stock mania of 2021. Now. Today. This is Buffett's biggest fear in 2026, and in the next 10 minutes, I'm going to break down exactly why, what it means for you, and how to protect your portfolio while everyone else is at the casino." Let's set the scene. May 2026. The Berkshire Hathaway annual shareholder meeting in Omaha. For the first time in 60 years, Buffett isn't on stage as CEO. He handed that role to Greg Abel at the end of 2025. He's sitting in the audience now, a spectator at his own legacy. But during a break, he sat down with CNBC's Becky Quick for an interview that's been replayed and dissected ever since. And what came out of that conversation wasn't a stock pick. It wasn't a forecast. It was a warning about behavior, about how an entire generation of investors is treating the market. If you've watched my channel before, you know Buffett doesn't waste words. When he speaks this directly, you listen. Buffett gave us one of the most quotable lines of his career this year. He described the modern market as, and I'm paraphrasing his framing, a church with a casino attached. People walk back and forth between the two. Right now, he said, there are still more people in the church than in the casino, but the casino has become enormously attractive. Think about what that metaphor actually means. The church is long-term investing, buying a business because you understand its value, and holding it for years. The casino is something else entirely, short-term bets where the underlying business doesn't matter at all. Only the next few hours do. And Buffett's concern isn't that the casino exists. Casinos have always existed at the edges of markets. His concern is that it's pulling more and more people in, and that the wall between the two is getting thinner every year. Here's where Buffett got blunt. He took direct aim at zero-day options, contracts that expire within a single trading session. You buy in the morning, and by market close, it's worth something or it's worth nothing. His exact words. If you're buying one-day options or selling them, that's not investing. It's not speculating. It's gambling, just totally. Pause on that for a second. Buffett has never had a problem with speculation as a category. He's drawn that line carefully throughout his career. Speculation, in his world, is still based on some kind of reasoning about price movement. But a one-day option strips even that away. There's no thesis. There's no time for a company's fundamentals to play out. There's just a coin flip with extra leverage attached. And the scale of this is what alarms him. He said the volume of these trades pouring into the market is, in his words, incredible, a level of speed and quantity that has no historical parallel. For Indian viewers, this isn't an abstract American problem. Look at what's happened with weekly and even daily expiry options on Nifty and Bank Nifty over the past few years. SEBI itself has flagged that the overwhelming majority of retail traders in index options lose money, and the shorter the expiry, the worse the odds get. Buffett looking at the US market and calling it gambling is essentially describing the exact same pattern playing out on Dalal Street with NSE derivatives. Then Buffett moved to something newer, prediction markets. These are platforms where people bet real money on the outcome of real-world events. Elections. Sports. Even geopolitical events. And he brought up a case that's almost unbelievable. A U.S. Army soldier, Gannon Ken Van Dyke, was charged by the Department of Justice for using classified information about a military operation to capture Venezuelan President Nicolas Maduro, and allegedly used that insider knowledge to make around $400,000 trading on the prediction market Poly market. Buffett's comment on one-day options was almost sarcastic because of this case. His point was, nobody can rationally explain why you'd buy an option that expires in a single day, unless you happen to have inside knowledge of an event that's about to happen. And that's exactly what this soldier had. He also noted that college and professional athletes have been caught trying to manipulate prediction markets as well, which tells you this isn't a one-off story. It's becoming a pattern. When you create a market where someone can profit from knowing the future before it happens, you create enormous incentive for exactly this kind of behavior: insider trading, match fixing, information leaks. This is a structural risk that didn't exist in markets a decade ago. And Buffett is one of the few voices loud enough to make people pay attention to it. Now let's talk about why Buffett isn't just morally uncomfortable with this, he's positioned for it. Berkshire Hathaway reported a record cash pile of around $397.4 billion at its 2026 annual meeting, up from roughly $373 billion at the end of 2025. That's not pocket change. That's more cash than the GDP of most countries. And here's the part that should make you sit up. Of the 60 years Buffett has been running Berkshire, he says only about 5 of them were genuinely juicy, with opportunity. The rest of the time, the best move was patience. Doing nothing. Waiting. Why is he waiting now? Because valuations are stretched to levels that have almost no historical precedent. Some market trackers have pointed to the Shiller-Cape ratio, a long-term valuation measure, sitting at levels only beaten once before, in December 1999, right before the dot-com crash. That's the kind of historical company current valuations are keeping. Buffett's read is simple. When prices are this elevated and speculation is this rampant, the smart move isn't to chase the casino. It's to hold your cash, stay disciplined, and wait for the moment everyone else stops answering their phones, because that's historically when the real opportunities appear. Now here's where I want to bring this home for our audience, because this isn't just a Wall Street story. India has seen its own explosion in retail derivatives trading over the past few years. Index options volumes on the NSE are among the highest in the world by number of contracts traded. Lots of new traders have entered F&O markets, many of them young, many trading purely on momentum, news headlines, and telegram tips rather than any real understanding of the underlying business or even basic options pricing. Buffett's warning translates directly. A one-day Nifty option and a one-day U.S. equity option carry the exact same mathematical problem. Time decay works against you violently. The house, meaning the market makers and the more sophisticated players on the other side of your trade, has a structural edge. And no amount of feel or chart pattern changes that math. If you're someone running a SIP into index funds or blue chip stocks, none of this changes your strategy. You keep contributing, you stay boring, you stay invested. But if you've been pulled toward daily options trading because of social media hype or quick profit stories from friends, this is Buffett, one of the greatest investors who ever lived, telling you directly, that's not investing. That's the casino. And the casino, statistically, almost always wins in the end. So what's the alternative? Buffett didn't just criticize, he gave us the other half of the equation too. His advice, as always, comes back to 2 timeless principles. First, be fearful when others are greedy, and greedy when others are fearful. Right now, by his own description, greed and gambling fervor are near record highs. That's not a signal to join in, it's a signal to be more careful, not less. Second, focus on businesses, not bets. A real investment is built on understanding what a company actually does, how it makes money, and whether you're paying a reasonable price for that. A one-day option or a prediction market wager has none of that. There's no business behind it, just a number that moves up or down based on something that has nothing to do with value creation. For Indian investors specifically, that means treating your SIPs and long-term equity holdings as the church, and being deeply skeptical of any temptation toward daily F&O trading as the casino. Buffett isn't telling you markets are bad. He's telling you to know which side of that building you're standing in. Warren Buffett has built one of the greatest fortunes in history not by predicting the next day's price movement, but by ignoring the noise entirely and focusing on value, patience, and discipline, for decades at a time. In 2026, his biggest fear isn't a recession, or AI, or interest rates. It's that an entire generation of investors is forgetting the difference between investing and gambling, and won't realize it until the casino sends the bill. If this breakdown helped you understand what's really happening in today's markets, hit subscribe. I break down Buffett and Munger's biggest lessons every week, with a focus on what they actually mean for investors here in India. Drop a comment. Are you in the church or the casino? See you in the next one.